Imagine landing 500 enterprise AI deals in just 90 days. NetApp just did exactly that, proving the AI gold rush isn't just about flashy GPUs, it's about the data feeding them. Welcome, and thank you so much for coming to watch the video today.
Yeah, 500 deals is just a staggering number. I mean, when you look at the sheer volume of those wins, it completely shifts how you need to think about the infrastructure supporting this AI boom.
Exactly. And we're jumping right into another installment of our earnings decoding series, where we take these dense boardroom financials and translate them into the ultimate tech and investing insights for you. Today, we're looking at NetApp's Q4 and fiscal year 2026 earnings call.
And honestly, the numbers here are pretty wild. I mean, we should probably set the stage with the raw financials before we get into the heavy tech stuff.
Let's do it. What are we looking at for Q4?
So NetApp just reported a record Q4 revenue of $1.95 billion. That is up 12% year over year.
Wow, okay.
Yeah, and for the full fiscal year, they hit $6.93 billion, which is a solid 5% increase. But it's not just the top-line growth that stands out here.
Right, I saw the profitability number.
Exactly. They hit record highs in operating income and earnings per share, which came in at $2.43 non-GAAP for Q4. And they generated this massive free cash flow of $1.87 billion.
Okay, let's unpack that, because when I see those kinds of numbers, $1.87 billion in cash flow, I try to visualize what's actually happening out there in the server rooms.
Right. What does that actually buy?
Yeah. Like if we think of those incredibly expensive GPUs as the high-performance engines of this AI boom, is NetApp basically building the high-speed fuel lines?
I really like that analogy, but let's take it a step further. Imagine you've built a multi-million-dollar Ferrari engine. That's your GPU cluster, right?
Okay, tracking.
But right now, most enterprises are trying to fuel that engine using a garden hose attached to a rusty tank.
Oh, wow. That sounds terrible.
It is. The demand for AI is skyrocketing. NetApp logged over 1,100 AI wins in fiscal year 2026 alone. But the reality is that the real bottleneck isn't getting the compute power, it's their unstructured data.
Okay, so how does NetApp solve the garden hose problem?
They are capitalizing on this concept they call zero-copy data activation.
Wait, zero copy. Hold on, I need you to explain that. Copy it to where? Why were we copying data in the first place?
Well, traditionally, if an enterprise wanted to run an AI model on their corporate data, they had to undergo this massive data migration. They had to extract it, transform it, and copy it into a separate data lake.
Just to let the AI look at it.
Exactly. And moving petabytes of data is incredibly expensive, it's slow, and it opens up a huge surface area for security risks.
So zero copy means you basically stop moving the mountain to the factory and just build the factory next to the mountain.
Spot on. NetApp's infrastructure lets companies plug their AI tools directly into their existing data footprint. They activate the data for AI without ever having to move it or create a duplicate.
Which saves money and tightens security. That makes total sense. And I'm guessing that explains some of these other massive growth areas they reported.
Oh, absolutely. All flash storage revenue hit $4.2 billion. Then you've got Keystone, which is their storage as a service offering that jumped 65%.
65%. That's huge.
Yeah, and public cloud grew 18%. Plus, they expanded their Google distributed cloud partnership specifically for highly secure sovereign environments.
That momentum has to be fueling their fiscal 2027 guidance.
As they're projecting 8% revenue growth, hitting a midpoint of $7.45 billion. And the big news for investors is they're committing to return 100% of free cash flow to shareholders.
Wow. All of it.
Every bit of it. Backed by a brand new $1 billion share repurchase authorization.
Okay, and correct me if I'm wrong, they did issue a pretty clear warning about their margins, didn't they? It wasn't just all sunshine and buybacks.
No, you're totally right. They gave a very strategic heads up that product gross margins will likely hit a trough like their lowest point in the July quarter.
Just because of component costs.
Yeah, entirely due to rising component and memory costs across the tech industry right now. They do expect those margins to gradually improve as their own pricing adjustments take effect. But July is going to feel the squeeze.
Right. And, in just a second, we're going to dive into the Q&A session where Wall Street analysts basically grill the executives on that exact margin squeeze, memory price hikes, and AI revenue secrets.
The Q&A is always where things get interesting.
Always. But before we get into that exciting analysis, please take a quick second to click like, share this video, and subscribe to the channel so you never miss an episode of our earnings decoding series.
All right, let's get into it. because the analysts were definitely applying pressure right away.
Yeah, they really were. David Vogt from UBS was right out of the gate asking about that July margin trough and the cadence of demand.
Right, he was trying to figure out if there was any pull forward in purchasing. Like, are customers buying now just to beat industry price hikes?
And what did management say?
They stated, momentum is strong with really minimal impact from pull forward demand on the P&L. They confirmed July is the expected trough for gross margins, with gradual improvements expected throughout the year as their price hikes kick in.
Got it. And Amit Duriani from Evercore ISI pivoted to flash storage, right? He asked about the drivers behind that 18% all-flash array growth,
Yeah, he wanted to know about the attach rate between new AI compute deployments and NetApp's high-performance storage.
which goes back to your Ferrari engine analogy.
Exactly. Management pointed to those 500 AI wins in Q4. High-performance flash is being deployed to ensure those expensive GPUs are fully utilized. Plus, hybrid flash is growing for the less demanding AI stuff. Both segments are really strong.
Then Eric Woodring from Morgan Stanley jumped in. He inquired about how much of the FY27 revenue guidance is actually driven by these recent AI wins.
Right. He asked for the split between on-premise and public cloud, and also asked if the gross margin guidance had an element of conservatism in it.
Because of the component costs.
Yep. And the response was that all 500 recent AI wins are on-premise, a mix of enterprise and neo-cloud. As for margins, they said the guidance is just based on current component cost info. They'll adjust prices if costs keep rising to protect those margins.
Okay, Wamsi Mahan at Bank of America kind of attacked the demand question from another angle.
Oh, yeah. He asked how the large deal pipeline is evolving.
Right, and he specifically asked why NetApp isn't seeing a massive scramble from customers trying to accelerate purchases ahead of rising memory prices.
It's a great question. Management said large deals are driven by AI and modernization, and they're winning business outside their usual base. But they haven't seen massive pull-forward purchasing simply because most enterprise customers lack the budget flexibility to do so.
So they can't just move a massive server buy-up by 6 months.
Exactly. So NetApp is just focused on balancing supply and lead times.
Moving to the cloud side, Tim Long from Barclays asked about the sustainability of their public cloud revenue growth.
And he also asked if that massive 65% growth in Keystone is actually durable or just a temporary reaction to high NAND pricing.
Meaning customers are just renting to avoid buying expensive memory right now.
Right. But management pushed back. Cloud storage services saw 30% growth, and they expect continued acceleration. They said Keystone's growth is driven by a broad, durable market shift toward consumption-based IT models, not just temporary pricing tactics.
That makes sense. Then Samik Chatterjee from JP Morgan brought up something structural. He asked about the impact of the extra week in Q1 on yearly seasonality.
Right, because an extra week messes with the year-over-year comparisons. He also asked about the specific opportunity created by that Google Hybrid Cloud agreement.
Right, the sovereign cloud thing.
Yeah. Management said if you adjust for the $65 million revenue bump from that extra week in Q1, seasonality is totally typical. And the Google deal significantly expands their reach into highly regulated, sovereign, and national security environments.
Wow, that's a massive market. Okay, Stephen Fox from Fox Advisors got back on the pricing train.
Yeah, he wouldn't let it go. He asked how higher NAND prices affect the corporate margin mix.
And he also wanted to know how much revenue growth is purely from higher average selling prices, or ASPs, rather than volume.
Management played it close to the vest. They said NAND prices primarily impact product gross margins. They raise prices to offset costs, but it takes time to flow through, so they declined to quantify the exact ASP revenue impact this early in the year.
Ah, gotcha. Then we had Jake stepping in for Aaron Rakers at Wells Fargo. He asked for early feedback on the AFX and AID solutions.
Right, and he also tried to nail down when those all-flash pricing adjustments will actually translate to revenue.
So what's the deal with AFX and AID?
Well, AFX is seeing really good early wins in neo-cloud and financial services. And AID is getting great feedback for helping customers organize their unstructured data. As for the pricing, they said price increases generally take 1 to 2 quarters to flow through to the P&L.
Okay, so there's a lag. Then Mike Cadiz, who is on for Ajia Merchant at Citigroup, asked the classic Wall Street question.
Oh yeah, the M&A question.
Right. He inquired about their strategy for strategic M&A in fiscal 2027.
And he got the standard answer. Management stated they constantly evaluate M&A opportunities for capital allocation, but they will not rule anything in or out at this point.
Standard corporate speak. Okay, Krish Sankar from TD Cowen asked for details on a specific large neo-cloud win.
Yeah, he wanted to know if they were sole-sourced. And he also tried to get them to state what percentage of product revenue comes specifically from Gen AI.
Did they give him a number?
Nope. They said the win was with a top 5 U.S. neocloud, expanding into enterprise AI, leveraging NetApp's hyperscale experience. But they flat out declined to break out a specific percentage of revenue generated by Gen AI.
Which makes sense given how broad AI is right now. Param Singh at Oppenheimer shifted the focus back to aid. He asked how it will be monetized.
Right, and if it's viewed as a tool to gain traditional market share or just an add-on.
And how are they playing it?
Management said it serves two purposes. It creates a sticky competitive moat for the existing install base, and it helps win new customers when they bundle it with storage for data lake environments. Pricing basically just depends on data volume and the specific services offered.
Nice. Catherine Murphy from Goldman Sachs asked a really strategic question about how their go-to-market strategy is evolving.
Yeah, specifically to capture the neocloud and sovereign AI opportunities.
Are they doing something different there?
Definitely. NetApp has actually built a specialist team specifically to pursue AI opportunities. And they've expanded their direct coverage of accounts to aggressively capture market share.
You have to have specialists for that stuff. Simon Leopold from Raymond James pointed out that the guidance implies relatively little sequential growth later in the year.
And he also asked about supply chain constraints outside of memory, specifically hard disk drives.
Are they worried about hard drives?
Not really. Adjusting for Q1's extra week, the guidance implies standard mid-single-digit growth for the rest of the year. They are monitoring HDD constraints, but they feel really confident they can source adequate supply to meet their outlook.
Good to hear. Ananda Barua from Loop Capital asked for a view on the normalized growth rate for public cloud.
Yeah, he really wanted to understand the mechanics behind its gross margin expansion.
How does that work?
Well, first-party and marketplace cloud storage are growing rapidly. And the public cloud business actually operates at the high end of its 80% to 85% target margin range.
Oh, wow. So as it grows.
Exactly. It creates a nice profitability tailwind as it becomes a larger piece of the total revenue pie.
Makes perfect sense. And finally, Nehal Chokshi from Northland Capital Markets. He tried again to get a specific percentage of bookings or revenue tied to AI.
Yeah, he was persistent. He also asked if the revenue per deal has increased.
But management held firm.
They did. They reiterated that they do not break out specific revenue or bookings numbers for AI, and they just noted that deal sizes vary widely across the spectrum.
All right. So bringing the conversation back to the big picture here, after going through the presentation and the Q&A, what are the main themes we should walk away with?
I'd say the main takeaway is that NetApp is successfully positioning itself as the foundational data layer for the enterprise AI revolution.
Even with the margin pressure.
Yes. Despite macro headwinds like rising memory costs, their strategy of zero-copy hybrid infrastructure and flexible consumption models like Keystone are really working. It's driving record profitability, massive free cash flow, and sustained growth.
Incredible. Well, thank you so much for coming to watch the video today. If you found this breakdown valuable, please take a second to click like, share the video with a colleague, subscribe to the channel, and stay tuned for upcoming content in our earnings decoding series.
And I want to leave you with a final thought to mull over. We talk endlessly about the race to acquire AI chips, right? But as we just heard today, chips are totally useless if they are starving for information.
Absolutely.
So going forward, the true winners in the AI revolution might not be the companies with the most compute power. It might actually be the ones who figure out how to seamlessly feed their massive, messy, unstructured data into the machine. Is data storage actually the ultimate AI moat?